David Crawford joins me now in the studio. David, thank you so much for joining us. Stocks or bonds? I mean, it does seem that actually it's going to be very difficult, probably very volatile, but at the end of the day, are equities still the bigger returns?
I think they are, and particularly if you look at certain parts of the equity market. So stocks look cheaper than bonds, but I think you have to place yourself in the right area. So defensive growth or even defensive business are often where you find the high free cash flow yields, the high dividends, which is where they look cheaper than bonds. So I'd be steering my portfolio towards those areas and perhaps away from the more racy areas, the blue sky areas. I mean, you'd expect smaller companies and high beta to do well if the market does rise, but it may be we see a period now where the sort of growth and defensive growth actually outperforms the rest of the market.
David, I also wanted to ask you specifically about BHP, because this is becoming a huge story. They went hostile just over 40 minutes ago. It does seem that they're almost desperate to get their hands on potash. Why this interest in agricultural commodities?
Yeah, I think BHP is regarded one of the highest quality mining stocks, perhaps the highest quality in the UK market. They do the right things over longer term, and this is quite a long-term play. I mean, the fertiliser stocks have been quite weak relative to some of the miners because their markets haven't really picked up yet. But BHP is looking quite far out here and saying over the next 10 years, this is where we want to be. This is probably the highest quality, the biggest play in the sector, and we want it. And our question is, what will they have to pay for it? But these stocks has underperformed, say, BHP. So these markets have been quite weak, the fertiliser market. So if they can look further out, perhaps they can pay a bit more than people expect and get something that actually rewards them over long term. But obviously, investors will be nervous about how it will impact them in the short term.
Is there a real risk that they actually overpay? And does it also mean that actually the M&A market in general is coming back?
Yeah, I think people might perceive they're overpaying on a 1 to 2 year view. They will be pretty confident they're paying the right price on a 5-year view, and that's why the BHP stock's coming off, because it's perhaps going to cause, I imagine it's going to be earnings dilutive in the short term if they pay up, but they'll be thinking longer term and trying to get investors to back them on that view.
Are we going to see a rival coming in also wanting potash? I mean, how attractive exactly is this asset?
I think they may well do. It's obviously there are various ways of trying to get exposure to fertiliser, and you can do some new build, but this is obviously a very large company that's already obviously listed and been going for quite a long time and got lots of assets and revenue. So it is going to be attractive, particularly if you're a big player, because BHP is a huge company. So other large companies, they want to get into this market, will need a big acquisition, and this is the biggest.
David, how much are you actually looking at earnings? We have around 75% of the companies in the US having reported in the last 6 weeks, beating estimates, earnings per share. Is this an indication of where you want to be in, or is that irrelevant? Really?
Well, you've got to be careful, because the worst thing you can do as a fund manager is pay a high multiple of peak earnings, and that's what everybody's perhaps worrying about. Now, it shouldn't be peak earnings because we should be fairly early in the economic cycle, but perhaps certain sectors may have actually gone a bit too fast. Maybe the industrials where we had restocking, and that's where you may get some softness, and you don't want to be paying a high multiple of those earnings. So I think you have to be a bit careful at this point in the cycle.
So if you want to shift to higher quality companies, are you looking at companies exposed to emerging markets, or are you staying away from the ones that are purely European based because of the austerity measures? Yeah,
I think you either go for, if you've got a business with emerging market exposure with growth, it's going to be more expensive, but then you have got growth, or you go for something with less growth, maybe a pharmaceutical stock, but that's much cheaper. So you've got to balance the growth versus the growth versus the value, and I think you need a combination of both.
So how much pharmaceutical stocks would you, for example, own? Talk me through your really ideal portfolio, broad picture.
Yeah, well, I've got a big position in Glaxo and a position in Sanofi, both very cheap, I think pretty good quality pharmaceutical stocks.
David, thank you so much. David Crawford there from Octopus Investments.